right, let's talk about what's happening in the markets, especially with respect to increasing household debt, reducing time horizon for equities. What are some other triggers or alarming factors in the market that perhaps you and I are missing out on and we need to pay more attention? Harshvardhan Roongta joins us to talk about all that and more. Mr. Roongta, thank you so much for taking time out. Let's talk about some negative trends that need attention. Of course, markets is something that has been very, very volatile and very, very weak over the last couple of weeks. Macros have been weak. But if we look more deeper, what are some other indicators, some other triggers that we're perhaps missing out on?
Well, Karuna, you're talking about the young generation, the millennials, and forget what we look into what the market does and reacts to global situations, etc. But if you have to just look at individually with the people and their behavior, especially the millennials that you're talking about, so well, it's an era clearly for them about instant gratification. I mean, it's very unlikely, and nor do they have the patience to even look for financial needs or foresee the financial needs that would come probably 15-20 years from now. I mean, it's all about living in the present. You talk to a 25-year-old who's just possibly got a job, and then you try and talk to them about planning for retirement. It's nothing less than a joke for them. I mean, talking about retirement when you just got your first job, I mean, it's all about fancy cars at this juncture, the bigger TV sets, high-end mobile phones. It's all about those, the new concept that has come in to collect, memories, collect experiences rather than, go on holidays rather than save. So, well, financial planning in that sense doesn't say that you do not enjoy your life in present. What is mistaken is that you need to definitely plan for future as well. Does not mean that you have to sacrifice your present. And if you look at all the offers and anything that you want to buy, you want to go on a holiday, you want to buy a high-end phone, a bigger TV, a bigger car, a fancy bike, all these things are available in easy EMIs. So this lures a person into saying, I can afford an X amount of EMI. Why not upgrade myself from probably a small car to a bigger car right now and enjoy life? So, well, it's true. I mean, there's nothing taking back from them saying that please do not enjoy your life. But a simple formula, if incorporated into financial life, will really sort out things for the future as well. Simple things such as if a person could simply talk to themselves and say that I first set aside a portion of my income towards my needs for long term. It could be short term or long term needs, financial needs. It could be a 20% to start with. So you just simply say that at 20% of my income, now I don't have this particular 20%, or my income has gone down by 20. And this 20% you set it aside for your short term and long term needs. The balance amount that is there in your hand, the rest of the 80% of your take home income, you can simply do whatever you wish with it. So you could spoil yourself, you can splurge, you can upgrade, go on holidays. That's no problem. But just make sure you have some side towards your long-term needs, because it's only you who have to fund yourself in future as well. So I think this one basic formula, if they're able to incorporate into their financial lives, it will sort out a lot of things. They will be able to enjoy the present and secure a future as well.
Okay, fair enough. But which are some trends that have really stood out for you and which perhaps need immediate attention and which could play out as a larger and perhaps more threatening or negative trend going forward, if it's not addressed on time?
Well, Karuna, I'm not able to hear you clearly, but if I understand correctly, are you trying to ask me about what exactly is the kind of approach they should take for short-term and long-term investments?
Harshvardhan, I was actually asking you, what is the most pressing need right now? Which is the one perhaps trigger or one factor that needs immediate attention?
Okay, so what needs resolution in that sense is the approach. As I said, you could just keep a simple approach saying that, I need to enjoy my present. Well, there is no harm in doing that. That's exactly why you're earning. You need to live in the present as well. But just a small portion of your money. So it could be just about 20%, as I said. Just set it aside and think this income is not yours anymore. This is to fund and take care of yourself in the future. So if that one approach can be rectified, I think it'll be much more simpler for them to manage their money.
So how can they manage their money better over the short term and over a longer term horizon if they want to sort of get into the art of planning their money well?
Let's just focus on this 20% that we've been talking about. So if it is this 20%, of this 20%, of 15%, so the major part, about 3/4 of this money should go in for long-term needs. So you will just simply park it aside to say, this is nothing that I will require in the immediate future, and I'm going to need it and I'm going to use it only at the time when I don't have income for myself, or I'm not able to earn. So that actually means retirement for that sense. It could be early 40s, late 40s, early 50s, or actual 60. So that is immaterial, but then you have to have sight and keep some money aside for that period when you're not going to be earning. So if you're looking at that longer term horizon, then equities of course is the best asset class, and you can invest via SIPs into it. Now, portfolio construction, equity funds, I mean, if I have to name some of them, just to give you a broader idea, so we're looking at large cap and multi cap combinations. So schemes such as Axis Blue Chip, ICICI Approved Blue Chip, Kotak Standard Multi Cap, or an SBI Multi Cap Fund. So these will have a tinge of mid and small cap as well, have a large cap portfolio, which is actually the portfolio that you will want to carry on till retirement. Now the balance 5%, the 1/4 that I was talking about, that should be kept aside for meeting emergency needs. So many a times life throws up surprises onto us and we are not prepared for it. So there could be some financial requirements which could be really as an emergency. So 1/4 of this particular amount that you're setting aside, you could put it towards emergency funds. Now because they could be required at any point in time, it makes all the more sense to have this available in a non-volatile asset, in an asset which basically you can remove money at call, and whenever you want you should have access to that money. So short-term funds actually fit into this kind of a requirement. An IDFC short-term bond fund, or an ICICI short-term fund, or an HDFC short-term fund, these are the schemes that you could possibly invest your money into. These will give you liquidity as an option, won't be as volatile as equity is, and will serve the purpose for as an emergency fund for you.
In terms of asset allocation, what according to you is an ideal asset allocation for a millennial?
So as I said, you can have a 1/4 and a 3/4. So probably about a 25% in debt, which is for short-term requirements, and a major component, about 75% of your savings, should go into long-term needs, because you're a young lad, you do not have too many responsibilities on yourself. So you will want to take the maximum benefit of wealth creation over long term, and that can happen only through equities. So SIP is the route that you have to take, because markets are volatile and you would want to keep buying into every level the market touches, and that's actually how your money is also coming in. If you're getting money every month, you might as well invest it every month. So an SIP route for long term through an equity mutual fund is one of the best routes that they can take. I've given you two names in the large cap and two in the multi cap category, and 25%, the 1/4 of your investments for short term needs. And if you have any specific goals, for instance, that you would want to study after 2 years for further studies, or marriage, you want to fund your own self, then that allocation will be up over and above this 20%. This 20% is to meet long term and emergency requirements only.
Right. I'm looking at some numbers and some statistics thrown out from an AMFI report, and it says the proportion of retail investors who held their mutual fund portfolios for more than 2 years has more than 60% in 2013, and it has now fallen to 40% levels. Why do you think the time horizon in investments, in equity investments specifically, has gone down so much?
I just think it's a factor of market volatility. It's a matter of not understanding what you're actually doing. Well, we have been continuously speaking about this fact that equities is a long-term investments. You need to hold that money for a long period of time, and if you're investing through SIPs, market has its cycles which you have to live through. You have to be with the different cycles. Only then will you actually start getting the benefits of rupee cost averaging. That is the advantage of SIP. But unfortunately, as much as we speak, as much as we try and educate people, it is a matter of time when we will see that people will start realizing this and not go as per the herd mentality. It's actually the reverse of what should happen. We see when the markets are at their peaks, we'll see new investors coming into the picture because they want to take the advantage, and they've looked at only past returns. When markets actually start going down, then all the investors start moving out of the market when actually they should be coming into the market. So well, it's only a matter of time. It's, I think, what our channel, what all of us are continuously doing is trying to educate the investor to make him aware that what you should be ideally doing. And I pray as much as you do and hope that investors will understand this and stick on and continue beyond the 2 years or 5 years that we've been looking at and talking about.
Okay. To what extent are these, ads which claim surefire trading strategies responsible for such impatience in the market and the lack of the kind of perseverance and prudence that's required?
Karuna, can you repeat your question? I didn't.
I'm saying that the trend wherein the time horizon has gone down drastically. If you look at the way people are investing in equity markets and the amount of time they are spending in equities, to what extent can you attribute it to these surefire trading strategy ads and people who claim to know the trading strategies and claiming to get it right all the time? To what extent do you hold that responsible?
So if I understand correctly, we're talking about people trying to time the market or getting fearful about volatility. If that is what your question is, yes, we've seen people entering into stock markets without actually understanding their functions. We've seen people investing into stocks only because having seen some past returns or been promised or been assured some kind of returns. So it's something that you will have to understand as an investor, that equity markets do not have anything assured in it. It takes time. It has to, if you're investing via SIP, then you will have to be in the market for a continuous period to actually experience all the different cycles. You will have a bull phase, you will have a bear phase. So having invested across 3 different cycles is when you actually start accumulating the benefits. And unfortunately, investors do not stay beyond one cycle. Either they're experiencing a bull phase and then they trying to book profits, and if the markets are going down, they get very fearful about what is going to happen, and then they start moving out. So I think a large portion, exactly in percentage terms I will not be able to quantify, but a large portion of investors are actually doing this, and which is working negatively in their favor.
Okay, Mr. Roongta, let's start off with some viewer queries as well. I'll just read out the first email. It's from Ritesh Agarwal. He says a year ago he started following SIPs and wants to know whether he should continue or switch to new funds. He's 37 years old. His goal is to accumulate funds for retirement and his son's education. If you look at his portfolio, he has a Mirae Asset Emerging Fund, 25,000 is what he invests there. This Canara Robeco Emerging Equities, 30,000 goes there. L&T Mid Cap, 30,000 there as well, and SBI Small Cap Fund for 15,000. So if you look at his portfolio, the current one now, what is your sense? Should he stay put, or should he perhaps relook at it and invest elsewhere?
As far as Ritesh's portfolio is concerned, it's nice to see that he's investing about ₹1 lakh every month, and he's just restricted his investments to just 4 schemes. So I think that is good, because otherwise when we get queries like these with people investing about ₹1 lakh, they will land up having about 12 to 15 schemes in their portfolio. So on that count, he's done extremely well to keep his portfolio very concise. The purpose of diversification, etc., is already achieved, so that you need not worry. Given his allocation, so he's got 2 large and mid caps. He's got 1 dedicated mid cap and one dedicated small cap. So an allocation perspective, when you look at the portfolios of each scheme as well, the allocation is primarily into mid caps. I mean, he's got a larger allocation to a mid cap, but that's fine. I mean, that's not really a alarm bell at this juncture. I have my reservations about a dedicated small cap fund that he has in his portfolio. What I'd recommend that he can either switch out of this fund into either an international fund, or he'll have a pure large cap fund. An international fund will give him a geographical diversification as well, and there are a lot of other advantages associated with an international fund, which adds a lot of advantage to his portfolio. So if he goes in for an international fund, he can look at the ICICI Pru Blue Chip US Blue Chip Fund. So this is a fund which invests into US listed companies. So ICICI Pru US Blue Chip Fund. Or if he looks at a large cap which is investing domestically in the country, you have an IDFC Nifty fund or an Axis Blue Chip fund. So IDFC Nifty is an index fund, a passively managed large cap, and Axis Blue Chip is an actively managed large cap. So he has several choices that I've given him. If I were to suggest and construct his portfolio, I would first, hope that he invests into an international fund. As I said, that gives him a lot of geographical diversification, the exposure into companies which are not listed in India. So he gets advantage of, the large giants, global giants such as Google, Microsoft, etc. And in case he's not comfortable with that concept, then of course we've already given him a choice with a dedicated large cap, a passive and an active. So IDFC Nifty or an Axis Blue Chip, either one of the two he can be investing into.
On to the next email query then. It's from Sumit Sengupta. I'll just read out his investments very quickly. He has an LIC term plan for self. 50 lakh rupees is the worth of the plan. ABSL term plan once again for self. 1 crore is the worth there. Voluntary Provident Fund since 10 years. 3,000 rupees per month goes there. NPS since November 2018. 3,000 rupees go there as well. If you look at his portfolio, there's ICICI Pro Blue Chip Fund for daughter studies, Franklin India Focused Equity Fund, UTI Equity Fund, L&T Infra Fund, HDFC Small Cap Fund, there's Kotak Standard Multi Cap Fund as well, HDFC Mid Cap Fund, and lastly there's the PPF once again dedicated to his daughter, and an LIC Insurance. So his portfolio is fairly vast right now. He also has term plans. He has a few very specific goals. Let's understand those as well. He wants about 50 lakh rupees worth of corpus for his daughter's education by 2029, and his retirement is in 2036, so he wants a corpus of 1.5 crore rupees for that. Given his investments at the current point in time, whether it's insurance term plans or whether it's his SIPs, what is your verdict?
So Karuna, we've seen that, and we just spoke about investing in the number of schemes. So we spoke about Ritesh, where he had 1 lakh of rupees investing only into 4 schemes. Now in this case, Sumit, we have 17,500 being invested every month, and he's chosen 7 schemes for this 17,500. So it's a bit too much to manage to under the name and the concept of diversification. There are too many schemes in his portfolio. I would construct and align his entire portfolio in the following manner. So Sumit, you can park your 17,500 rupees in the following schemes, which I'm going to name. I have picked the schemes from your existing portfolio, so we're not adding any new schemes in your scheme of things. So an ICICI Pro Blue Chip Fund, where you're currently investing 3,500, increase that amount to 5,000. Kotak Standard Multi Cap, now you will invest 7,500. HDFC Mid Cap Opportunities Fund, another 5,000. So your 17,500 will get invested into just these 3 schemes, which are easy to manage, easy to track, and they're very good schemes in their own categories. With regards to the investments that you already have in your portfolio, I would recommend redeem all of them and split them into these three schemes itself, so that you'll have a very concise portfolio which is easy to manage and track. With regards to your targets that you have, that you wish to have 50 lakhs by 2029 and all that, I think the portfolio that you've constructed for yourself, you have debt in the form of your provident funds, you have an insurance, etc. I think that along with your SIPs should be good enough to meet all your expenses, all your targeted goals that you have. However, it's just going to be a touch and go kind of a situation. So keep in mind that if your income goes up over the years, just make sure your investments also go up proportionately. So which means that if your income goes up by 10%, make sure you start investing a higher amount by that same 10%, and don't just leave your investments to whatever you've done right now. Income goes up but investments are not going up. So just make sure your investments go up in the same proportion as your income goes up year on year.
Okay. Moving on then to another email query that we received from Uma Maheshwara Rao. He's a retiree. He got about 1 crore rupees as retirement benefits from EPF and gratuity. He has saved SCSS worth of 15 lakhs and PMVVY 15 lakh is the amount for that as well. And if we look at for the investments and savings, he gets pension of about 24,000 rupees. For future security, he's invested 60 lakh rupees in mutual funds. Just if you could review his portfolio for the benefit of our viewers as well. Franklin Templeton credit risk, Franklin Templeton dynamic accrual, Franklin Templeton's income plan, Franklin Templeton ultra short term bond, and ICICI credit risk fund. He also has a few hybrid funds, Mr. Roongta, Sun Life Hybrid Equity, HDFC Hybrid Equity Fund, ICI Pru Balanced Advantage Fund, IDFC Dynamic Equity Fund, and SBI Equity Hybrid Fund. So once again, he has spread it all out. If you could review the portfolio for us and recommend some changes, if at all any, that you think might benefit him in a better way.
Well, Karuna, if you're looking at his portfolio as a retired individual, I think he's got a good approach to investing. So he has his current expenses being taken care by all the senior citizen savings schemes, the post office schemes, and his pension. So his current requirements being taken care of. All his money that he's investing is for creating some corpus and some kind of a buffer when his expenses go up, but the income, the pension, etc., does not go up that much. So I think the approach is perfect. So 60 lakhs that he's invested across mutual funds for for an interim to future requirements, I think it's fine. Just that the schemes that he's chosen unfortunately have let him down. So he's got a couple of investments in Franklin mutual fund and all the debt schemes. So, and unfortunately all of the schemes that he's investing into right now have seen portfolio segregations being done on account of investments that they have in Vodafone Idea. So there has been a markdown on all those papers, as a result of which there has been a substantial reduction in the yields. In fact, some schemes would even be giving negative returns in that sense. And so that's kind of been a setback for him. So my suggestion to him is to move out of all the schemes that he has with Franklin, because all of these schemes have been have been inflicted with this Vodafone Idea papers. Redeem out of everything that he has in Franklin and invest this into a scheme which holds only AAA rated papers and is a short term fund. So the volatility or the risks involved in the debt schemes will not be there. So IDFC bond short term fund is the scheme that he can redeem all these Franklin mutual fund investments and park that money. Whatever has been invested, and now as a result of the segregated portfolio, there is no choice, he will have to be invested in them until they derive a value. When they have some recoveries, NAVs will be reflecting accordingly, and then that time he can take a call. But until then, all the other portfolio, the regular portfolio that he has, can move to IDFC bond fund short term plan. With regards to the ICICI credit risk fund, well, ICICI hasn't experienced any default in payments yet. So that's until up to that part is fine. Just that he's a retired person, and I don't think there is any need for him to take exponential risk in terms of a credit risk fund. So in that context, he can switch out of the credit risk fund, but stay with ICICI mutual fund into their other scheme, which is a short term fund. This has a portfolio which is primarily a AAA, and about 18% of the portfolio has a AA investment. So from a credit risk fund, he's just moving within the same fund house into an ICICI short term fund. So I think this is a change I will recommend in his debt portfolio. With regards to the hybrid, he's got a well diversified portfolio across different fund houses, and all the schemes that he's chosen are fine. So I don't think there's any need to be any changes need to be made there.
Okay, I hope all our viewers are taking note of the recommendations that Mr. Roongta is giving. Thank you so much, sir, for joining us once again and helping our viewers out as well with their respective concerns and queries about their portfolios and financial planning. With that, we're slipping into a short break here, but we have plenty more lined up when we come back. Stay tuned.